Hello there, this is forexbrokers.net, and today we will discuss different trading styles when covering the FX market, or different trading styles when looking at other financial markets, because the styles are the same. And we deal with time horizon, with the time horizon that a trader has, and then what works for each trader, advantages and disadvantages. You will find out both in the article that comes with this video and in this video. But I wanted to reinforce a bit with one video the characteristics of each trading style. First of all, it all depends on the time frames. These are the time frames that you may find on a trading platform regarding the broker. You may have ticks, or you may have seconds, 1 minute chart, 5 minutes, 10, 15, 30. Some trading platforms also offer the 2-hour chart, and so on and so forth. Many of options available for the day-to-day trader. And the lower time frames are dedicated to scalping or automated trading. Now, what is the difference between the two? Scalping can also be manual trading, and scalping refers to or traders do scalp on time frames starting with 1 minute chart to all the way to 15 minutes time frame, but not much more than 15 minutes. For instance, let's go on the 1 minute chart. On the 1 minute chart, this is the US dollar and Japanese yen. On the 1 minute chart, we see each candlestick here represents 1 minute, and scalping means that traders go in and out of the market manually, mostly for very short term distances. So you are not looking for hundreds of pips of profits or something like this, but you're looking for small profits. And if you couple 5 pips, for instance, per trade, or 10 pips per trade, or times 10 trades a day, then you will have 50 or 100 pips one trading day, only by interpreting various time frames like these ones on the 5 minute chart. Scalping goes best with technical indicators. Imagine that you can add the RSI here, or you can add oscillators or whatever. So think of technical analysis when it comes to scalping. Automated trading as well. Automated trading means that you are able to use expert advisors or strategies, automated strategies that will trade for you, and usually those are not applied on the bigger time frames, but those are applied on the lower time frames, 5 minute chart, 1 minute chart, and so on, because traders will try to make the most on all the market swings, on all the currency pairs, and therefore it is more difficult to monitor the lower time frames 24/7, 24/5 as the FX market is open. But it is possible to do that using an automated strategy. The disadvantage of using scalping and automated trading on the lower time frame is that you will often have slippage, especially on the 1 minute chart and so on. Imagine that each candlestick here represents 1 minute. Now, see here, there is always, from this candlestick to this candlestick, there is a gap. It's not big. 104.87.7, it was the opening. The close 104.87.6. But when you scalp, or when you instruct your expert advisor or your robot, your trading robot, your automated trading strategy, to buy or sell at the close of a candlestick, and then this happens so fast and so quick that this difference here is called slippage. See here, another slippage from 104.88 all the way to 104.87. So this is almost 1 pip slippage. If your trading strategy has a take profit of 10 pips, 1 pip means 10%. So this is a cost to consider. Another trading style is called, let's go here on the daily chart. So on the daily, we said that we have scalping or automated trading. Another trading style is called swing trading. Swing trading. Swing trading has the big advantage that a trade is not closed at the end of every day. During scalping or scalpers, they close positions at the end of every day, and therefore they start the next day with a clean slate, if you want, and there's no pressure. There's no pressure to look at what's happening overnight and so on and so forth. Swing trading a swing trade can take from a few hours to a few days, weeks, or even months. It is still a swing trade, and has the big disadvantage or advantages, depending on the world that you are living in, of paying swaps. So when you consider swing trading, then you must interpret swaps. What is a swap? Swaps. A swap is based on the interest rate differential between the two currencies that the market has. For instance, this is the US dollar and Japanese yen, and you look at the federal funds rate in the United States, you look at the interest rate set by the Bank of Japan, and the bigger the difference between the two, the bigger the difference that you will have to pay as a swap, in negative swap, or you will receive in positive swaps. As the central banks lower the interest rates in response to various crises that we had in the past, the great financial crisis 2008-2009, then the 2012 European sovereign crisis, then 2020 the coronavirus pandemic and so on. The response was that the monetary policy was depressing the interest rates, and now almost all rates are close to zero or even below zero, like in the case of the ECB that holds the deposit facility rate below zero, the Swiss National Bank minus 0.75, in Japan also minus 0.1, and so on and so forth. So most of the swaps are negative, and when you swing trade, it means that often, very often, almost always, you keep positions open overnight and you end up paying a positive or a negative swap. Keeping positions open overnight may end up being beneficial if the currency pair pays a positive swap, like it was the case for many years being long US dollar and Japanese yen, when the interest rate in US was bigger than the one in Japan, or being long Australian dollar US dollar when the interest rate in Australia was much bigger than the US dollar, the so-called carry trade. So one disadvantage is negative swap. So if you consider trading a pair with a negative swap, then you must account for the costs caused by it. So swing trading, any trade that you may take between the hourly chart to daily chart, it may take a few hours to a few weeks or even more. And then finally there is investing. Investing is mostly fundamental and not technical. Of course that investors that have a longer time horizon, I'm talking about years, they look at the monthly chart and so on and so forth, and maybe they will draw a trend line at the chart just to see a dynamic support or resistance level. But other than that, you won't see much of a technical analysis. Investors, instead, they look at changes in the macroeconomic picture. What it means if the Fed, for instance, change the mandate from dual mandate that looks at employment and inflation, change the mandate to an average inflation targeting, and so on and so forth. What are the implications? When will the market move? And they will take a position, scale into a position at different levels, trying to make the most out of it. So to sum up, we have here scalping, swing trading, and investing, with the difference between them being the different time frames, the time horizon for a trade, and various costs associated with each style. Let's move on with the next video. Bye bye.